Well, welcome to our latest issue of Friends Talk Money. We spend a lot of time talking about retirement, and I think the very word retirement involves a four-letter word that we don't like to focus on, that four-letter word being risk. There's so many risks about retirement. You work your whole life, and then you've got this sum of money, and you deal with the risk of what if it's not enough? What if I run out? How do I invest it? What kind of risk do I take? What things could come along and destroy my retirement plans? Richard and Pam, what do you think of when you think of retirement? What biggest risk do you think?
I think I'm just like everybody else I ever talk to, whether it's personal or professional. I worry, am I really going to have enough runway? Am I going to have enough, cash, to last forever, as long as I do? Am I going to be comfortable, when I get to the point where I might not be able to completely be independent? Please, can I just be independent as long as possible? I do not have children. Now, for some people might say to me, well, even when you do have kids, they don't necessarily come to the rescue. But look, in my family and in my life, I see having children as being a huge security blanket, mentally, emotionally, and all of that. But I've always been independent. I don't have children. I have nieces and nephews. And that's my fear is, if I am going to be alone and I am going to be at a point, God willing, I'm not, or I have to depend on somebody and some place and professionals or whoever to help me, I don't even want to think about what that's going to look like.
That's a huge risk, and many women tell me, Richard, you're on the cusp of you've walked into retirement and backed yourself out because you're doing so many things now that I think you're probably doing more in retirement than you did when you were full time. But what's the risk that haunts you a little bit?
Well, I think the risk for me and for a lot of people is not letting our money work as hard as it could, because we're so nervous about running out of money that we don't want to invest any money at all. We're afraid that we could lose a penny because the stock market might go down at some point, sometime, for some amount. And so we want to keep all of our money 100% safe in the bank, which is certainly going to be safe, but it is not going to give you much of a return. And we're living longer lives than we used to. So I think that's the risk that I see in retirement is not letting our money work for us.
Yeah, I feel that exactly with you. You're leading us right into the subject of our podcast today. We know that if you had X $100,000, you could buy an annuity right now and get a guaranteed X $1,000 a month for life. And you wouldn't run out, except for, oh my God, what about the risk of inflation? At only 3% inflation, the value of that fixed check, is cut in half in 25 years. So we know intuitively, we need to take some risk with our investments. The question is how much risk and how do you move around and how do you ascertain if this is a moment to be taking less risk? I mean, 2 years ago, it looked pretty darn risky and the market's, gone on to new highs. And 2 weeks ago, the market looked pretty risky and yet it hasn't collapsed. So this could be at any time in your lifetime. So for that today, I want to start a discussion with someone whose risk management advice, money management advice, I have followed for years. Let me introduce you to our guest today, Jim Stack of InvesTech Research. Let's bring him in while I tell you that since 1982, he's written the InvesTech newsletter, and he has a big money management firm. He's been lauded. Hi, welcome, Jim. I'm about to sing your praises. Jim is coming to us from Whitefish Bay, Montana, which already proves he's smarter than we are, right? Welcome.
Yeah, it's a little cold out here in Whitefish, Montana right now, but we have lots of snow, great powder skiing.
Okay, and I was there last spring for your conference, which I'm going to harken back to. Let me just say that, Jim, I've been following your advice. In 1987, you first became famous for telling people to get out before that Black Monday crash. And in 1999, in the height of the dot-com bubble, you were warning not just the week before, but I mean, for months and months before about the danger of the bubble. And of course, when it came, it took the market down. Popular averages down 50%. and we'll never again see this pets.com sock puppet. So a lot of stocks just
I do remember being labeled out of touch with the new paradigm in the Wall Street Journal at the time, at the height of the tech bubble.
Okay, now before anybody
just interject, I remember Jim.
Before anybody thinks that Jim is only a doomsayer, let me say that I was in the audience at the Money Show in Orlando in January, February of 2009. The gloom was so thick. Remember, people's houses were being foreclosed. Nobody wanted to buy stocks. Jim's newsletter that month came out, Toro, 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 bull, bull, bull. And this whole room full of thousands of people sat there while he said, this is the buying opportunity of a lifetime. Remember where the Dow was back then? It was 11,000.
Let's put it this way. The major indexes were off over 50% from their highs in 2009. People think a bear market is 20%. No, that's the minimum definition. About every 14 years or so, typically on average, you have a bear market come around. That can be a doozy. That can be a 45% or more. And in that one, the S&P from top to bottom in 2007 to 09 lost over 55%. It was a scary time. Economists were forecasting, I remember one of the headlines, economists forecast continuing gloom for the next 4 years. And yet that is when, characteristically, you have that bottom drop into place.
Yeah.
It's just, everyone's so scared to go near it, and they've lost more than they could afford to lose.
Yep. Jim, I'm also a fan. We met several years ago. I've been following you. I'm ready to come up to Montana any minute, believe me. It seems like, most bear markets, generally speaking, when you think of a bear market, they typically last, really around a year, maybe 6 months to 18 months at the most.
Longer.
People get conditioned by the last 5 or 10 years. Investor memories don't go back very far, except for those who are in retirement or nearing retirement and ride through one of those generational bear markets that come around more than once a generation. They can let their friends lose half their portfolios. The thing to remember about bear markets is that they can be very short, and it was very short a couple of years ago in 2022, and part of that was because of the massive amount of liquidity injected both by the government and by the Federal Reserve after COVID. We haven't had a real bear market since 2009, so it's been 15, 16 years now. That doesn't mean you put your money under a rock and hide, but it does mean that you know how to or learn how to manage risk. We're still close to 60% invested in this market, which I'll be honest, isn't much lower than where Warren Buffett is with Berkshire Hathaway. And people don't think of Warren Buffett as a market timer. Risk management is not market timing. It's basically understanding that as you accumulate assets and you get into your 30s, 40s, 50s, 60s, you need to have an increasing amount of respect for that risk, and you take steps to manage risk. There's several ways you can do that, and you need to look at all three of them.
Jim, can I just say that I think that a lot of our audience are either in retirement or near retirement, and for them, the thought of a 50% fall in their portfolio is a very frightening thing, because they're thinking to themselves, I don't have that many years to catch up after that. So what do you tell somebody who's 65, 68, who says, gee, bear market's coming, we don't know when, but what am I going to do then? What do I do now?
Number one, and this is at the top of the list, and I'm saying this because my indoctrination in the stock market came when I was out of college. Terry knows this story many times. I came out of college and went right into the 73, 74 bear market. I was an engineer, IBM Research. I had the world by the tail, and I lost half of every penny I put into the market because everything went down.
Wait, time out. I was there. I was on the trading floor of the CBOE. The Dow went from over 1,000 to a low intraday of 570.01. And I looked at all the traders, and I was so young and so naive. I said to this one old guy, Paul, where did all the money go? And he looked down at me and he said, well, my dear, it went to money heaven. My first bear market
It
lesson.
it does evaporate into thin air. But back to Richard's question, I think the most important thing for people in retirement or nearing retirement today, in a stock market that is by almost most metrics at the most overvalued levels in our lifetime, even higher than the tech bubble in some regards, is to sell down to a level of comfort. With investing, I've learned this and I've practiced this over the years. There's never a last train out of the station. Investing opportunities always come around again. And very often, the very best buying opportunities come after the washout of a market that is coming down from extremely overvalued levels. Like the height of the tech bubble, the bottom that we had in 2002 was spectacular. And as you said, Terry, from 2007 to 2009, that was an 18-month grueling bear market, took the S&P down over 55%. Dow wasn't safe. NASDAQ went down far more than that. And it was a buying opportunity for a lifetime. So sell down to a level of comfort. For us right now, that's around a 60% or so invested allocation. And then there's two other ways you manage risk. One is by sectors, and the other is by stocks. And the highest risk in this sector is very similar to the highest risk that I had when I started investing back in 1973, 74. And that is the concentration risk. In 73, 74, they were called one decision stocks, the Nifty 50. You bought them and you never had to make a decision to sell them. And those 50 stocks, because everyone had piled into them, went down far more than the S&P or Dow did. Today, it's the Mag 7 or it's the Big 10. The concentration in the 10 biggest stocks in the S&P constitute almost 40% of the index. And if you're in those 10 biggest stocks, when they go down, it is going to be like a roller coaster ride. And that doesn't mean you sell all of your Apple or your Microsoft but the thing is, sell enough of it, take some profits to the bank, and put the money into safe treasuries. You can't get 5% anymore. The Fed's made a couple interest rate hikes, but you can still get a really nice fat T-bill rate in the 4.5% range. And sit on that and realize that if we are in a topping process, then within the next, let's say, 12 to 24 months, we could be possibly looking at one of those buying opportunities of a lifetime.
Yeah.
Yeah, I do feel like there are some retirees who say, gee, I don't want to sell any of my stock because then I have to pay taxes. But I think what they don't remember is that the stock market went up about 25% overall a year for the past 2 years. Be thankful for that, be grateful, sell a little bit, pay some taxes, and sleep better at night.
And you're probably paying a 15% tax rate,
Yeah, I mean, capital gains tax. Remember back when I started investing, capital gains tax rates were basically at the same as ordinary income.
Yeah.
So you have a phenomenal benefit in a low, marginal long-term capital gains tax rate. The thing with taxes, with capital gains tax, it's the price for making good decisions.
Yeah, it's a caviar problem in that sense, right?
Yeah.
And by the way, if your money's inside your IRA, you're not paying any capital gains taxes. You'll pay ordinary income taxes when you withdraw, unless it's a Roth. But it's not even a tax consideration.
Yeah.
Now, you said asset allocation, you said sectors, and you said stocks.
Individual
Is there a better place? I want to just recap this. I think it went by real quickly, but you said that the market is more overvalued today in general than at any time in our history. I just want to make sure I heard you correctly.
Yes. There's different ways of looking at valuation. You look at price to book value, but that's not relevant today because back then we had manufacturing companies 30, 50 years ago. Today we have digital companies. So that's not a great metric. You can look at price to earnings ratios, but they generally don't look that bad right at a market top. They turn very sour, right after the market top. And one of the best valuation metrics that always comes back to a historic norm is the market cap, the price of the entire stock market to GDP, to the output of the US economy. It is Warren Buffett's favorite. It's often called the Buffett valuation indicator. And that market cap to GDP is higher today than it was at the height of the tech bubble.
Yeah, which is
That says, it says be careful.
Yeah. Jim, what I want to ask you here, or what I want to throw in here, is that I want to bring this back out to away from valuation just for a second, and more about the setting that we're in right now and the frame of mind that people are in right now. Obviously, I don't care if you're like, yay, I'm so excited about this new administration, or whether you're on the other side, fearful. The emotions around the uncertainty of what's going to happen next.
Right.
Is a big deal for people right now. So when they're looking at asset allocation, meaning how much money of my entire, holdings, savings, do I have in cash, treasuries, those 2.9% or 3% or 4% investments, when inflation's running at 2.9% at the same time, knowing that can't be the be all end all answer, knowing that the stock market is, considered to be overvalued, if you will, historically right now. And you look at real estate and you look at, okay, where are all the other places where I'm investing, to be able to really understand where you sit in that mix, given the uncertainty of how you feel, whether you're excited or whether you're fearful, and sitting down and just kind of knowing and anchoring yourself in the knowledge that, oh, okay, that makes sense. I have enough in cash to make me feel comfortable. I have some money in the stock market, enough to watch it grow. Within that portfolio, I'm going to make sure I'm diversified, because diversification wins all battles. Right. And I've got my real estate and so forth. I think that when people can look at it like that and think of asset allocation just in that way, it kind of can help anchor you in feeling a little bit more in control, because you are in control. You're not in control of what happens there, but you're in control of how you react to it with your money.
And I think, to put the valuation perspective, think about it in terms of something that people are more familiar with, like real estate. You own a home and you look at a home across the street that's suddenly selling at like twice what it was 5 years ago. And it's a ridiculous level. Would you go over and recommend buying that home at that price, knowing that in the past prices have come down hard? Probably not. That's how you look at valuation in the stock market. It doesn't mean you go out and sell everything. It means you basically dial back to that level, sell down to that level of comfort, and then stay away from the most overvalued areas. And today, the two most overvalued sectors in the market, this is based on relative PE ratios too. The two most overvalued sectors in the market are technology and consumer discretionary. And then if you want to go out and look at where the best bargains are in the stock market, energy is selling at a 50% discount based on its historic norm in price to earnings ratio. That doesn't mean go out and put all your stocks in energy, all your capital. But it does mean, if you're going to hold on to some energy holdings, consumer staples. Walmart is one particularly great stock, and it's been hitting great highs this year. It's one it's our largest holding on our money management side of our companies. And then you've also got utilities. There's nothing wrong with owning a good utility, paying a good dividend yield.
What are the dividends on, Jim? What's the average dividend on a typical blue chip utility these days?
Yeah, I leave that to our portfolio team. But you can get a good dividend, and they can actually hold up very well. And often they will even go up in a bear market. That's not, again, it's not market timing. It's realizing that take the highest risk money, pull profits off the table, pay you look at it as a penalty. No, pay the reward of having a good decision, making a good investment, pay the capital gains tax, and then put the money, at least temporarily, into treasury bills, knowing you're not planning on staying there, ad infinitum. But if we get toward that great buying opportunity, that's when you put that money to work. You mentioned something really interesting, and that was the market's reaction to the election of Donald Trump. Obviously, stock market liked it. There's they call it the Trump rally. I'm going to step back about 40 years ago, a little more than that, to the election of a very popular president at the time, Ronald Reagan. In the middle of 1980, it was nip and tuck between Reagan and Carter, but as it went to election, he pulled away, and he won by one of the biggest landslides in U.S. history on the political spectrum. There was a Reagan rally following that, and then, due to circumstances that could not be controlled, we went into the deepest recession since the 1930s. It wasn't the biggest bear market because stocks weren't at extreme overvalued levels like they are today. But what I'm saying is, don't base your investment decisions on politics, because there's not a direct correlation.
The economic cycles, the business cycles, they're rolling along. And then you've got your political cycles. And I think it's the media, and everybody talks about, if Trump does this, or if Biden did that, or if Obama had done that right then, it's going to have an immediate reaction. And it's attributed to whoever's in the White House. And it's like, there's only a few things that are directly that fast. I mean, everything takes so long to work through the economy. By the time I touch something here, it might be 2 years.
Well, and the way it's often looked at by young investors, and I looked at it this way, is that, wow, you have politicians up there and they're going to control it. They're going to prevent a bear market. That doesn't happen. I'm sorry. But they also look at interest rates, and they look at the Fed and they think, well, they're going to control this motorboat. It's not a motorboat. It is a massive barge moving up the Mississippi, and any decisions have to be made a year ahead of time. And very often, if it's on a collision course with a recession, it's too late to make that decision to suddenly avert that, what is an economic downturn. And economic downturns are always preceded by the top of the market, not vice versa. People may think, well, I'll wait until I see we're going into recession and then I'll sell. By the time you do that, you're probably going to be over halfway through the bear market.
Jim, is this a time for investors to diversify internationally? Are other stock markets less overvalued than ours is, or are they all pretty much the same right now?
Well, globally, markets are less overvalued than the U.S., and that's almost across the board. The difficulty right now is there's not great values out there anywhere. I think it is a valid way of diversifying the risk in your portfolio, and that's important. You don't have to just stay out of or reduce your allocation in the Mag 7 or the top 10, but look at some international. There are some great diversified international funds. Look for the international funds that have value in them and carry a high Morningstar rating, like a 4 or a higher Morningstar rating, and put 5–10% of your portfolio in those. We don't have that allocation in our portfolio right now, but it does make sense in terms of diversification.
Jim, you're not only a great market historian, and by the way, I don't know because you send it to me free for 40 some years, but what does a subscription to InvesTech newsletter, InvesTech.com cost?
An annual subscription is $175, but we always run discounts. If you call the office, they'll tell you if any of those discounts are available. And what we try to do it's funny, I've been doing this for 45 years with InvesTech, and what we try to do is make sure that when people are on board, that they understand risk, they learn the importance of risk management, and they learn the lessons of a bear market without going through one of those major ones. Because, it's not how much money you make in the bull market that counts. It's how much you have left after the next bear market does its damage.
How profound. The reason I brought it up is because you have all these wonderful graphics. You also have, just briefly, some proprietary market indicators. You mentioned the one about the market cap to GDP, the Buffett indicator. I do remember in 1999, I was giving speeches all over, and I had to keep remaking the chart because that line, the valuation of the market compared all the stocks value total compared to GDP went off the chart. Now we're more off the chart. But you have a couple of other indicators, and one of them I think is pretty interesting to ask you to talk about. It has to do with housing.
It's funny you would mention that, because on the date that we're actually recording this, we put together an index. We did this in the back in 2005, because we felt housing was in a bubble. We put together what we call our housing bellwether barometer, and it ultimately became known as our housing bubble bellwether barometer. And we said, watch this index. When it peaks and it starts falling sharply, it means if housing is going to come down, that spills over into the broader economy. And I know it was brought to the forefront in Forbes. And then, of course, it did peak. It fell 18 months ahead of the bear market. That housing, and then we brought that back out, and is composed of home builders, home finance companies, everything that's on the leading edge of benefiting from a booming housing market, but then having a very bad time when that turns. So we're watching those leading companies, and that housing bubble bellwether barometer today that we reinvented about 2 years ago, 18 months, 2 years ago, is now already almost 30% off its high. That's how far it's fallen in the last 60 days.
So we're taping, we should fair to say, on February 7th. We'll try to get this posted as quickly as we can. But your indicator has fallen 30% from its high.
It's over 27% today.
Okay.
Last
time around.
Does that mean that does it mean housing's heading for a crash? No, but it means there's a warning flag out there. If you have a home on the market, lower your price, try to move it a little bit faster right now, because it's sending, a red flag that housing is slowing a lot more than you're reading in the headlines, and it's going to get worse, not better.
Yeah, that's
one more indicator. The other indicator, you have another stock indicator. Why don't you just explain
we've got
well, you have a bunch, but
well, it's funny because when we get into these situations where we recognize, and I'm analytical because I was a research engineer with IBM, research and development. And so when I started in the stock market, I decided after losing, everything, not everything, but half of everything in 73, 74, I decided I've got to learn how to do this right. And that's not by listening to Wall Street. It's not by reading the headlines. It's by looking at the underlying macroeconomic, only the leading, not things like unemployment, but the macroeconomic evidence, and also key technical indicators. And in the tech bubble, if you remember, Terry, we had a tech bubble. We had an internet index. It was our internet bubble index, and it was tracking the extreme speculation of the time. In this case, about 3 years ago, we invented our AI bubble index, and it's gone parabolic. Boy, I wish I'd owned those stocks 3 years ago, because they kept going. They kept going up for over a year, 18 months, almost 2 years. But now it's looking like this. It's looking like the peak of a mountain. It's gone up like this.
It does feel like a pets.com moment.
It does. It does. I have one of those puppets on my shelf that I bought at that time, because I knew it would be a collector's. But parabolic curves, an AI index went like this. Now it's starting to look like this, coming down the other side.
I want to poke in and say one quick little thing. It's so funny that you said that about the houses, because I have a house on the Cape, and I swear last summer it was like everybody in the neighborhood was getting real frothy, and all the houses, like I couldn't believe the prices I was seeing on the neighbors' houses sold, and I said to myself, "Ruh-roh."
Yeah, it
just felt a little toppy.
It's very subtle how it develops, and that's why we develop these tools to kind of the leading, basically the psychology in those leading, like the AI speculative stocks, and in the leading housing sensitive stocks. They give you an early warning. It's
so everybody wants to know this. Now I divulged the data on which we're talking. It's a good thing to timestamp this. And you've never done this. There's never been a time I've listened to you. You've never been on the money, and you've never called and said, okay, on April 6th, that'll be the top kind of a thing. But based on your perspective, is it fair to ask you how close we are to that top and what could trigger it? Or should we just take this warning and organize our risk tolerance within our portfolios to say it's coming, and nobody ever picked the top?
Well, I've been wrong, lots. Anyone who invests is going to be wrong. But in my mistakes, I have tried to make certain that when I make a mistake, I err on the side of caution. Because the penalty is I wait for the next buying opportunity and then I take better advantage of that. We were too cautious too early in the tech bubble. In this period, we were spectacular. We looked spectacular in 2022 in that initial drop, which did qualify for a bear market, but it was very mild. And in the last 2 years, we've left good profits on the table. But if I look at today's market and I look at what's happening in the housing, bellwether barometer that we have, and I look at the AI index, it's like what Pam said, ruh-roh, this is not, it's looking like we may likely have seen the major top in the market. Now, does that mean we're going to go down into 50% bear market? Maybe not, or probably not. But at the same time, when you're at the most overvalued levels in history, don't rule that out. And
what I think is so valuable about your sage wisdom here and Terry's wisdom in having you on right now is that we're talking also just as much about our reactions to this. And so I only want to just throw in one more idea that I have that I think works, which on that side of it, which is that, honestly, if you can look at what you have and, sell down, like to that comfort level and get really clear on why your assets are allocated across these assets the way they are, why you're diversified the way you are, then you can create, especially for people into retirement, like we are getting into retirement for me later, a little bit later, we can look at a plan that will be resilient and dynamic enough to almost, there's no such thing as completely bulletproof, but to do the best you can to bulletproof yourself. But psychologically, you're in tune with it. It's not that complicated to do.
Jim, I have two. Go ahead.
Go ahead.
I've got two final questions, but go ahead.
Well, something I learned, and I often share when I used to speak at conferences a lot, is the danger reality of reverse compound interest. What I mean by that is people say, oh, well, if, why do I manage risk if I'm only going to sell down to 40% cash? That's no benefit. The reality is this. In a big bear market, the big cap stocks, S&P, could lose 50%. And if you're in the more speculative or the momentum stocks, you could easily lose 60, 70%. And that may happen in that Mag 7. Remember, popping the tech bubble, the S&P went down about almost 50%, but the NASDAQ went down over 80%. Now, here's the secret. If you have a 50% loss in a bear market because you're investing in S&P or momentum stocks, if you have a 50% loss, it takes 100% gain to get even. If you can reduce that loss to 20%, what might be considered a small bear market, you're just reducing the risk. It only takes 25% gain to get even. In other words, that 50% loss is 4 times worse than the 20% loss. You're just taking a little bit of risk off the table in order to position yourselves for spectacular potential gains in the future.
So I've got two quick questions, Jim. One is anything you want to say about either crypto or gold? That's my first question. So let me stop there and ask you about those two.
Well, gold is a monetary hedge. Crypto is not. Gold has always been viewed, and it does have a value both in jewelry and still in electronics and stuff. Crypto is backed by the full faith and credit of Terry, do you know? I can't think of anything.
The full
People
faith
who
and
believe in
credit
it.
of all the people who think it's
You
worth
know,
something.
It's a fiat.
Until they don't.
It's
Fiat
Until they
basically
don't.
backed by confidence. And if that confidence ever disappears, well, we know what happened to the tulip bulbs in the 1600s. I'm
Okay.
not saying crypto is a tulip bulb. What I'm saying is that when mass psychology is just driving this asset to levels that seem pretty crazy, it's better to stay out of the
Yeah,
game.
the herd can turn the other way. Yeah.
Yeah.
The other question I had is, financial advisors often talk about lowering the percentage of stocks in your portfolio by your age. So I noticed that today Schwab is saying in your 60s, these days, you should have 60% in stock, in your 70s, 40%, in your 80s, 20%. I'm wondering, what do you think of that idea? And I don't mean those particular percentages, but just the idea of scaling back as you get older.
It's a simplistic way of saying, to allocate and manage risk. I think that's too simplistic. That basically saying it's basically saying that the risk in the market is the same all the time, and you never know when one of these
For
things is going to
everybody.
come
Yeah.
out of the woodwork. These have warning flags. They have danger flags. Those warning flags and those danger flags are flying today. If I'm in my 30s, I don't want 80, 90% of my money all in stocks, and particularly in big cap stocks today. Sell down to the level of comfort where you can sleep at night. If this market isn't a bear market, or if it starts going down, it will drop very quickly, as it does out of overvalued extremes. All of a sudden, you'll wake up and within 40, 60 days, it'll be down 15%. And that's when the bear market traps start. That's when you start rationalizing, holding on all the way through the major bear market. Oh, I've already lost more. I've already lost 15 or 20%. I've already ridden through a bear market. I'm going to hold on. And then you get down 30% and 40%, like 2008. And then it goes S&P in the first quarter of 2009 that Terry talked about. It's down over half. You've lost more than you could afford to. And then, and only then, the worst headlines hit. And you go, I can't stay.
That's when you ditch.
And that's the panic moment.
Selling out at the bottom, selling out at the bottom of a big bear market is not emotional. It is the most logical and rationalized decision that an investor makes, but it's made too late.
And I guess you're saying also the flip side too, which is that just because you're in your 70s or 80s, that doesn't mean that you should always be keeping 20% or 40% in stocks either. It's all about where we are, right?
Absolutely. There's always room for good equities in your portfolio. Focus on value. Always focus on there are if you rank the sectors based on performance in bull markets versus bear markets, the sectors that are at the very top in the bull markets move right to the bottom in the bear markets. And those sectors are generally the same. They're the technology, consumer discretionary, financials, sound familiar? And then the ones that are at, generally lagging in the bull market become the most defensive and best performers in the bear markets. Those are the boring utilities. They are the consumer staples. They're the healthcare, and even energy is usually a pretty good staple, going through the bear market, because, no matter how bad, when you go into a recession, people are not going to stop driving their cars and turn off their lights.
Thank you.
Thanks, Jim. Okay, on that note, which is, we're waving the flag. It's overvalued. There's always room for some stocks, and it's all about risk management. I'm going to put you on the spot here, Jim. Let me direct our listeners and viewers, we're on video too, to InvesTech.com, InvesTech.com. I think if you mention Friends Talk Money, they might give you a free copy of the latest issue or access to it or something like that.
Absolutely. You can go up and get a free copy right now. That's already set up. Get the latest issue, because it'll read it and try to understand what we're doing. Is we're not perma bears. We're not calling for the sky to fall. But what we're saying is, here's where the risks are. Here are those big 4 indicators that we said to watch. And if you go up on investech.com, you can get free issue, download it right now today.
And there are also weekly or more frequent updates on the insights section. It's the one thing I've read forever and ever, and the one thing that has guided I've just listened to what you're saying and done what you said, and I'm here to talk about it as a result. So I thank you personally. I am so glad you joined us today, Jim Stack of InvesTech.com, and I'm glad all of you listened. We'll see you next time.
Bye, everybody.
Bye-bye. Thanks, Jim.
Bye.
You are awesome.
It was great. This was so fun, Terry.
Say this, you are the best guest we ever had.
I agree.
Yeah. We gotta, you know what? If promise us this, you'll be very busy in Fortune and Forbes, and the Journal will be calling. But when we're down 40 or 50%,
I will come on in, Terry. I can never turn you down. You
I
know.
love you, sweetheart. Thank you very much. Thank you.
Thank you so
Thank
much.
you.
Richard,
see
so
you
great
again.
meeting you both.
Thank you too. Remember,
And Pam, thank you for the very, very, very kind comments.
I remember,
met
Jim,
you a long time ago.
when I worked at Money Magazine in the 80s, you were a star even then. So it's
Yep.
nice to see you again.
Money
Yeah.
Magazine did my first photo in Money Magazine. It was a centerfold spread. They flew out a photographer from New York, Neil Slavin, and I am in Whitefish Lake up to here,
Right.
working on one of the first portables on the dock.
Uh-huh.
And he has a helper spraying the water to give an effect, and the drops are sprinkling on my portable.
Oh,
Back then,
no.
I'm going,
Oh
I
my
don't think this will ever work again. And it was September, and the lake temperature was only 65 degrees.
Oh, no.
I was in there for 3 hours.
Oh, I'm
Oh, my
sorry,
God.
Jim. I
All right, well, we will
apologize.
see you again. Thank
Okay.
you.
We'll
You
let you
bet.
sign
Thank
out.
you.
We've got to stick
Yeah,
around.
if you sign out,
Okay.
now, we'll get
I
Thanks,
on.
will
Jim.
I'll sign out right now.
Stay warm.
Thanks.
Yeah.
Take care.
Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks. So be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.